Look, guys and gals, it's sad, but it's true. About 99% of all investors, they do fail. Now, the good news is they fail primarily for two reasons. And if you make sure to stay on top of those two things, you're more than likely to be an investing success. So in this short video, I'm going to go through those two reasons why 99% of all investors fail, and I'm going to show you how to avoid them. I'll see you guys inside the computer. Okay, everyone, we're inside the computer and we're answering the question, why do 99% of investors fail? Now, I know there are studies that say 90% fail, some that say 80% fail. I'm pretty sure it's like 99%. So let's go figure out why they happen. And there's only really two reasons why this happens. So look, it's sad, right? But again, somewhere above 90%, I feel like is very close to 99% of investors, they fail. They lose their hard-earned money. And sometimes it happens a lot faster than anyone could even imagine, right? Now, the reality is, though, the reasons these investors fail consistently across the board is they're kind of doing the same things. And I'd like to break it down to two things right here today. So the first thing is investors across the board have the fear of missing out. And don't worry, we'll get into that in a minute's time. And the second thing is they set crazy expectations for how much money they can make, what kind of losses they are or should or are going to be incurring over their trading career. So we're going to break down these two things. This is going to be a little bit shorter video, but again, 99% of investors fail pretty much because of these two things. So first, the fear of missing out, and whether we like to admit it or not, we've probably all felt this at some point or the other, right? And there are two things, right, that people do here. Number one is when stocks are going higher. Let's say Apple is going higher. Investors, they're afraid of missing out on that guaranteed continuation. Thus, they chase the stock higher. So as Apple continues to go higher, people are going, oh my God, this thing's definitely going to go higher. I see it in the Wall Street Journal. I see it on Barron's. I hear about it on CNBC. This thing's definitely going to higher. And what do? They obviously go ahead and they buy it. Unfortunately, it doesn't really work out for people, right? The second thing is when stocks are going down. We've all been there, right? Investors are afraid of losing all their money because these stocks, right, they're guaranteed to continue going down. Thus, let's sell that stock before it gets worse. And we've all been there, okay, whether we like to admit it or not. I've definitely been there. And what happens when it gets really, really ugly is usually the stock comes around and turns around. And this can be visualized in a chart like this. So what we're looking at are the S&P 500, this blue line from what, 1980 to May of 2018, give or take. So what we can see here is that blue line, the S&P 500, and what this red line represents, or these red or green line represents, as we can see here, it's something called credit balance by Advisors Perspectives. Credit balance is calculated as the sum of free credit cash accounts and credit balances in margin accounts minus margin debt. So basically, without getting into it crazy, if we see red here, we're basically seeing a lot of margin debt, okay? A lot of margin debt. So when you go ahead and buy a stock, let's say you have a $10,000 account and you go ahead and buy $10,000 of stock. And as that stock goes higher, you do not have to incur any additional margin debt because you have gained the same amount of profit as the margin required to own that stock. The only way you will have to incur margin debt is if you buy another stock and don't have any additional value added to that portfolio. So as we can see here, as stocks are going higher, people are incurring more debt, right? Thus a negative credit balance in their account. That's how we see this red. So basically, as stocks are going higher, we're seeing more debt accumulated by investors because they want to buy more stocks and have to take on more debt in the form of negative margin debt to do so. And as stocks sell off, that's the only time that we see across the board investors not having any debt. So this is an excellent visualization of as stocks are going higher, people have that fear of missing out. And how we can visualize people having that fear of missing out is they keep on going into more debt to buy more and more stocks. And as stocks are selling off, they keep on selling, right? So they have less and less margin debt in their account. So again, this is the fear of missing out in a fantastic visual representation. Now, the second thing is setting inaccurate expectations. So, in the age of all these investing gurus, expectations for investors have been completely put into another dimension, right? Where there is now an expectation that serious wealth, like making millions and millions of dollars, can be created faster than ever, right? And look, it's very sexy and easy to sell when you tell someone, I made $1,000 gain on this pot stock because this trend line crossed this and I bought this call and used this leverage. But in reality, that almost never happens, right? Although for some people, it definitely has to happen because that's what the law of numbers say, right? But wealth can be created by pretty much anyone in the stock market. And wealth, I think, millions of dollars, right? However, in most cases, it takes many, many years, if not decades, of solid decision making to achieve those results. So over decades, you can generate a lot of wealth if you're making the right decisions over and over and over and over again. Now, this creates an investor being upset with a 10% or 20% gain for a year, even though that does outperform the market, when they see these gurus making literally bazillions of dollars overnight. People can't even stomach small losses that 100% come with investing. So how do we fix these two things that are really the reason why 99% of all investors fail? Well, number one, when people are really looking to buy, be ready to sell. And when people are really looking to sell, be ready to buy. And the second thing we can do is whatever your goals are with investing, like making millions of dollars, right? Set your goals for accomplishing that over many, many years and many, many decades. And do not set expectations for that happening any sooner. If you do those two things, you'll stay in the game longer, and you'll probably be in that 1% investor that is in the game generating wealth over a long period of time. I'll see you guys in the next video.